Aave is a crypto liquidity protocol. Simply explained, this means it's a lending and borrowing application. People with assets can put them on the application to earn an interest, and other people can borrow those assets and pay an interest. There's currently around $10 billion worth of crypto assets on Aave right now. In this video, I'll go over what all of this means, how it actually works, how it's replacing banks, and how to actually go ahead and use it to, lend out some crypto assets as well. All of the timestamps are down in the description below. Firstly, we have to understand what exactly is a liquidity protocol and a money market. This is how money markets typically work. You have a borrower and you have a lender. A lender has cash or some other type of cash-based asset, and they give it to the bank. The bank then uses their reserves to lend out to borrowers. But they don't just usually give money out to people. Maybe on credit cards they will, and they'll charge you a high interest rate. But most of the time what you need is collateral to borrow against. So most people borrow against something like a house. So you go to the bank and say, I want money to buy this house. And they say, we'll give you that money right here, but we'll charge you an interest, let's say 5%. You've just got a mortgage for a house. But if you don't pay back the loan, then the bank takes the house. That is a collateralized loan. The bank gives you money, charges you an interest, but they have an asset to take back and sell if you can't pay back the loan. Just really interesting here is that the lender, for putting their cash in the bank, gets about 0% these days. If you have a savings account, you might get 0.01 or something like that. Okay, completely useless and basically nothing. You, if you're a borrower, have to pay 5% or plus for your mortgage. The bank is therefore making something called a yield spread from their deposits and their loans. Now, there's some risk here because you're a borrower, but actually they have the collateral there as well. This is really important for Aave because they use collateral in the form of crypto assets. And so you get a good 5% fee rather than a credit card, which is uncollateralized, where you'll be paying something like 15, 20% or something like that. Here's how Aave steps in. Aave becomes essentially a decentralized bank because Aave is the protocol in the middle that is dictating the free and open market for crypto assets. So we have a borrower right here who wants to borrow some dollars. Why does he want to do that? Well, he's bullish on crypto and he wants as many dollars as he can to go and invest in some projects. But Aave doesn't just give money out. You need collateral to borrow against on Aave, and we'll look at that in a second on the site. But he'll put some Ethereum onto the Aave platform as collateral. Let's say he puts $10,000 worth of Ethereum onto the Aave protocol. Aave is going to say, thank you very much. You have $10,000 of collateral, and we are going to give you up to 75% of the value of your $10,000, so $7,500, as US dollar stablecoin. You can go and invest that as you want. Now, this guy is the lender, and he will, of course, put dollars onto Aave. Why does he want to put dollars onto Aave? Because he's a saver, essentially, and he wants an interest rate. Now, the big difference between Aave and banks is that Aave is a decentralized protocol, and so the interest rate that is paid between these two people is free and open from whatever the supply and demand of these assets is at the time. So let's say that this guy over here on the left is paying 5% to borrow dollars. Well, almost 90% of that is actually going to go to this guy. So instead of making 0% in a bank for his dollars, this guy is going to make, let's call it 4.5%. So he will make way more because the bank isn't in the middle. Aave takes about 10% of the value of loans on its platform as its fee. And you can, of course, invest in the Aave token and use it on the platform as well. But that's how it works. Aave replaces a bank, and it's a free and open money market between borrowers who want to pay interest and put collateral assets on the platform, and lenders who want to put their dollars or Ethereum or other tokens on to earn some interest from this money market. Aave relies on something called over-collateralization. This means that it will never let a borrower borrow more cash than the value of the assets that they have on account. This is to do with risk. Now, if you borrow more money than you actually have assets, how can a decentralized protocol manage that? For example, if you just don't pay stuff back and it doesn't have any of your assets and it doesn't know who you are. Well, that's impossible, and that's going to create a system where everyone loses money because everyone's going to borrow loads of money and not pay it back. So Aave fixed this by using something called over-collateralization. What you can see here is that the max LTV, loan to value, is 82.5% for Ethereum. That means that if you have $10,000 of Ethereum, you can only borrow 82.5% of that value in other coins, $8,250. So this is called over-collateralization because it's a decentralized protocol. They need to know that they have more assets on your account than you're borrowing against. So if anything happens to the value of those assets going down in value, they can sell those assets and still have plenty to pay off your loans. Why on earth would anyone want to do that? Well, very simply in crypto, you can speculate using your assets as collateral. So for example, if you are a borrower over here and a lender over here, let's say you have $100,000 of Ethereum and you think Ethereum is going to go up a lot, maybe 10 or 20% this year. Well, what you can do is go and put your Ethereum onto the Aave platform and borrow, in this example, 90%, $90,000 against it, right? So you have $90,000 borrowed in USDC, but you keep your ETH as well. Now, this is known as over-collateralization of around about 110% in this example. On the actual Aave platform, you can only borrow 82.5% specifically against ETH. Why would you want to do that? Well, if Ethereum goes up 20% in the year and you're paying around 5% to Aave, then you're paying 5% to borrow $90,000. You can go and buy more ETH with that and have almost twice the exposure. If you have twice the exposure and it does go up 20% and you've only paid 5% for a loan, you make 15% on double the amount of ETH exposure because you've been able to essentially leverage up your position, borrowing at 5, and you're taking the risk that ETH will go up by about 20%, and so you make way more money. You make a percentage, only 15%, but almost on double the exposure. That is why people will over-collateralize and actually borrow against their assets. There's also many other strategies that people can do essentially to arbitrage interest rate differences. So that's over-collateralization, and that's why people do it. From a lender's perspective, all you're doing is just putting some cash or other assets on there, and it will show you what the APY is that you can get to deposit each and every asset individually. On Aave, they will show you the APYs for every single asset on there. So that is the yearly interest rate. So if you go to markets and then down to whichever market that you want to use, these are all the assets that are on Ethereum, and each of these will pay a different interest rate dependent on supply and demand. You can see the total supplied is around $17 million worth of Binance US dollar. So this is a stable coin. If you supply, you will be getting 0.47% as an interest rate. Really, really low, not very competitive, but there are way more assets on here. You can see the amount borrowed in the market is around $5.5 million. So people are borrowing $5.5 million worth of Binance US dollar and putting up some sort of other collateral asset, maybe Ethereum or some other asset they want to keep, but they want to borrow dollars against. This market is simply a open, free money market where supply and demand match up to attain some interest rate that the protocol will determine. You can come down to any single asset. We've got a US dollar tether right here, and you can see the available liquidity, 250 million, but the utilization rate is actually quite low. 55% of the collateral is being borrowed right now. This is typically very low. So what this tells me is that crypto's in a risk-off environment right now. Not many people want to borrow dollars to go and speculate on other projects. Therefore, because this utilization rate is low, the interest rate will probably be quite low because they don't need to incentivize people to put more money into the platform. If the utilization rate goes up to like 90 or 95%, then they will increase the interest rate to attract more people to deposit dollars and bring that interest rate down to a good supply and demand balance right there. you can see actually down here how the system does that. You can see the interest rate model, the utilization rate, borrow, APR, variable and stable. On Aave, you can borrow at a variable rate, or you can pay more money and actually borrow at a stable rate. But the system, as you can see on the right-hand side, this is the optimal amount where the utilization is 90% of the collateral on there. And as we come down, this is the current. Because there isn't much demand for dollars, the interest rate is very low, but as demand for dollars picks up, the interest rate goes up exponentially to attract way more liquidity onto the platform and balance that supply and demand. Aave is a cross-chain protocol, meaning that it uses many different blockchain networks. All of these are compatible with EVM networks. So you have Ethereum and then other networks that use the EVM model. So you can very easily see them on the main page. You have the Ethereum market, then you have Avalanche, Polygon, Arbitrum, and then Phantom Harmony. And if you click on the right-hand side, you can see a couple more here. Aave Arc is the institutional market where institutions will go and trade. That has to be different because they use KYC. But what you can see is that you have Aave, which sits on top of other networks. These are the networks right here. All of them have slightly different risks in terms of how decentralized they are, but I'm sure you know all of these. And then you have the assets down here, which can be on all of the different networks. So if you go on the Polygon, Ethereum, Avalanche network, they all support, for sure, all of these assets. These are the biggest assets on Aave. So you have different risks, for sure. You can see the risks right here. Smart contract risk of Aave specifically. Each one of these lending protocols and markets rely on contracts, which is code that dictates the supply and demand of the assets. You put your assets here, they earn an interest, and then all of the smart contracts dictate the interest rate and, of course, the flow of all of those assets. There has to be smart contract risk with every smart contract, and so that is one of the risks. The second risk is blockchain risk. Specifically, which blockchain are you using? Are you using Ethereum, which is, very battle tested, or are you using maybe a smaller network like Phantom on Harmony? Harmony has been subject to a hack, so which one do you want to use? That's up to you, but each blockchain has a specific set of risks, or not, as the case may be. The next type of risk on Aave is liquidation risk. If you borrow lots of money on Aave and the value of your assets falls, then you could be liquidated. So for example, if I put Avalanche on the platform, and you can see you can borrow against this, max LTV is 65%. So I borrow tons of US dollars against my Aave position, and then Aave falls in value, then I could get liquidated. This is important if you are lending on the platform, to know that everyone that's borrowing and paying interest has to put up way more collateral. And so if prices do fall, the system will literally automatically sell them out of all of their loan positions to pay back the loans first. But there is still a small liquidation risk, given that the system may not be able to trade. In fact, if you go over to governance, you can see that Aave has an insurance part of the app. So it says Aave holders can stake their Aave in safety mode to add more security to the protocol and earn safety incentives. What this means is if you have Aave tokens, you can stake them on the platform and they will give you a staking APR of 9%. So you can earn a 9% yield on your tokens, which seems great. But this is what they call safety module. So if there are any non-payments of debt for some reason, the system wasn't able to trade out in time or something like that, and there's a shortfall, then they're going to take some of these Aave tokens, sell them in the market to make up the debt. And so you're getting paid 9% essentially for providing insurance to the protocol so that it can pay back all of its debts, just in case it for some reason doesn't have enough collateral or can't trade out in time. So that can only come in during very volatile market periods. And during recently one of the most volatile periods in crypto, nothing bad happened on this protocol. So you can make your decisions there, but it is something to be aware of. And there is, of course, asset risk as well. What I mean by that is that each and every asset has its own risk, of course. For example, holding Ethereum or Aave itself or Balancer tokens, each project has its own risk. And so that's very different to the specific risks of using this platform. Also with, some stable coins, they might be bridged over from other blockchains. For example, Ethereum has native US dollar coin and US dollar tether. Other smaller markets, for example, Harmony or something like that may actually bridge tokens over from Ethereum, which carries its own risk. And therefore, having US dollar coin or USDT on a smaller network might be an issue. That's also with blockchain risk as well. I'll leave my specific lending tutorial for Aave in the description so you can see what that looks like step by step if you need it. I'm James, this is Money ZG. Cheers for watching, and I'll see you in the next one.